So my name is Hudson Weston. I'm a finance major. I'm graduating this May.
Hi, I'm Tiffany Baltiera, economics major, graduating next fall.
And I'm Natalie Torrestate. I'm a finance major, and I'll be graduating in fall 2019.
So before we dive into it, we really want to thank you guys for coming out. This is really the backbone of the Investment Society. We work towards this event all year long, and it really means a lot to us, so thank you guys for coming out. So first thing we want to do is give you guys an idea of how the sector as a whole has performed against the S&P 500. So right here we have a 5-year chart. As you can see, the CD sector is up approximately 90%, while the S&P 500 is up 57%. Therefore, the consumer discretionary has been outperforming the S&P 500 as a whole in this 5-year period. And here's a year-to-date chart, same comparison. Once again, the CD sector has outperformed the S&P 500 by roughly 5%, increasing 22% versus the S&P 500, which only increased 17% this year. So we noticed when we started doing the analysis that the consumer discretionary sector really had companies within it that differed from each other pretty drastically. So we decided to break it down into 10 subsectors so that we could, in our models, more accurately allocate the weights for the valuations and hopefully get more valuable investment ideas. So we have the apparel subsector, automobile, restaurants, hospitality, home, education, stores, internet and specialized services, products, and a miscellaneous subsector. These are the industries included. I'm not gonna read them all off, but hopefully you guys can get a good idea from there. So what we currently hold, we hold about $11,000 in the sector right now. 34% is allocated in the apparel subsector, 22% to restaurants, so those two have more than half our holdings. 4% is in home, 24% automobile, 11% hospitality, and 5% in products. As you can notice here, we don't really have any education companies, so one of the pitches you guys are going to be giving you today is an education company. These are the specific companies we hold. We have Young China, Young Brands, TJ Maxx, which is our largest holding, Francesca's, Capri Holdings, American Outdoor Brands, Las Vegas Sands, Gentex, Board Warner, and Bed Bath & Beyond. So to kind of summarize our model and what we did, I'm pretty sure you guys have heard earlier today about our kind of valuation metrics here. So these right here are the fundamental weights, these first two columns, except for EBITDA sales and EBITDA EBITDA. EBITDA sales and EBITDA EBITDA is how we determine the market valuation, and all the other metrics is how we determine the fundamental valuation. So we look to maximize the correlation R-squared between these two ranks, between the market rank and our valuation ranks, which is based on fundamentals. And we were able to achieve a correlation of 81.7% and an R-squared of 66.8%. And here's the visualization that the chart really provides. Initially, we planned on pitching 4 stocks today, but due to the 20-minute time constraint, we had to narrow it down to 3. We're going to be pitching Urban Outfitters, American Public Education, Norwegian Cruise Line Holdings, and we plan on pitching Mattel as a short, but due to the time constraint, we're not going to be pitching it. I'm sure you guys have seen a model like this today, but essentially the stocks here are trading relatively rich, and they're trading above the line, are trading relatively cheap. As you can see, that's where our buys are versus our sell. So a higher fundamental ranking, which is how we rank it, is this way. So closer there, that's better fundamentals, and market the same way in a vertical way. So Tiffany and Natalie are going to be doing our first pitch on American Public Education.
So we're going to be talking about American Public Education. They were founded in 1991, so they're less than 30 years old. They're essentially an online-based post-secondary online education. They have over 90,000 students currently, and they actually offer very specialized degrees for military individuals and students, such as the National Security, Space Studies, Intelligence Studies, and Emergency and Disaster Management. And of course, they have an additional 106 degrees. How their business segment works is that they have a physical location in Ohio for a nursing clinic, and then they have these 2 online segments for that focus on the military individuals and non-military individuals. And Natalie's going to talk about the competitors and who our consumers are.
So main competitors of APEE. So competitors include other institutions like Ashford University, Capella University, Grand Canyon, and Liberty University. Why we believe in this company compared to the other competitors are there are people they serve and they are loyal that the students possess to their university. And mainly the main students, like Tiffany mentioned, that we have are 80% of our students are military based. So we already have a huge community of that and culture, and the professional, national, and local law enforcement. And I'm gonna pass it back to Tiffany for value and quality.
Do you want to talk about this? Okay. I don't think it transferred.
So to kind of summarize the revenue and EPS growth, we saw a spike in 2014 and it's declined since. EPS also suffered a similar trend, but we've seen a pop from 2017 to 2018, which Tiffany will explain the rationale why we believe this happened in the next couple of slides.
So, okay, so we're going to talk about their value and their leading quality, which have increased since that 2014 decline. So they were actually the first completely 100% online institution to be recognized by OLC for best practices. And since 2016, or since 2015, I'm sorry, they've been ranked as the top 10 nationally online universities among 292 schools offering online undergraduate education. A little bit about this. Okay, so on average, why this company is doing so well is because compared to public state university or public education, they're 19% cheaper for undergraduates and 33% less for undergraduates. They have a long history of creating value, especially these last couple of years. And in 2015, they received a world recognition for their online-based community. And then Natalie's going to talk a little bit more about that.
So yes, so when they go for the long term, they are sustainable for consumers wanting an education. So fees and books are roughly 90% less expensive for undergraduates and 33% less for graduate students than the average in-state cost here, like at UTSA, for example. So they're saving more money on that, so that's why it's very great university for this type of concentration that they're trying to pull in. And a little bit about right here, revenue and EPS growth. So when we see our revenue, and we saw that had a big strike, and then it was slowly falling down. I think the main reason for this is because this university is a very high concentrated in specific fields. So it only has it targets just specific concentrations and such. It's not a huge where it offers everything. But we also see right here that the EPS growth has increased in the past year, and we strongly believe it's gonna keep increasing because recently what's going on in the politics and everything, President Trump already released the highest VA bill, and he's really pushing for supporting our veterans, and the main thing for supporting them is for them to continue in education. And since our university has 80% for veterans, and that's mostly what they target, I feel that's why it's keep increasing. So these veterans are going back and choosing this institution that really helps with their schedule, and fees, like I mentioned before, are 19% less expensive. So that's why we strongly believe it's gonna keep increasing.
So we're gonna go more in depth about our SWOT analysis, their strengths, their weaknesses, their threats and opportunities. Like Natalie said, recently in last year, they passed a $200 million bill for VAs. So they're expanding their education opportunities. So that's one of their strengths. They have a successful integration of technology companies. So since it's very online based, they're really putting a lot of their efforts in having technology to expand the amount of customer base they have nationally and also internationally. They also have a high level of satisfaction. 56% of students who come back for a second degree. Some of their weaknesses is their lack of success of integrating with different work cultures. So when they do merge, it's a very difficult process for them. And they do, even though they're very diverse, they have some gaps in their products because they are very highly specialized.
And some opportunities we saw is they have a lot of opportunities for opening up new markets. because example of what's just going on with politics and everything, they're getting more people in, so they have an opportunity to expand and adopting new technology. And then example like the nursing school, they can have an opportunity to expand in that in new states. And some threats that we saw, they are operating in different countries, so it's exposed to currency fluctuations, but we believe that it can be taken care of easily, and shortage of skilled workforce in certain competitor or market distribution.
So just to briefly touch on the ownership of this stock, T. Rowe Price has a huge holding in this. Roughly 18% of the company is owned by T. Rowe Price, 14% owned by BlackRock, 8.25% owned by Dimensional Fund Advisors, and 7.63% owned by Vanguard. And looking at the trend since 2018 Q2, we have seen a pretty significant increase in BlackRock's holdings from 2018 Q3 to 2018 Q4, which further makes us more bullish on the stock. And we've also seen T. Rowe Price increase their holdings throughout the same period. Dimensional Fund Advisors and Vanguard have remained relatively stable. So the next stock we're going to be pitching is Urban Outfitters. We're giving it a buy rating. It's currently trading at $29.32. We see roughly a 36% upside for the stock with the $40 price target. Out of the 21 analysts on Bloomberg, 8 have recommended a buy and 11 have recommended a hold. This is the year-to-date performance right here in the 5-year. So the year-to-date it's down, and the 5-year is looking like consolidating between the $20 and $50 range. So to give you guys a better understanding about the brand, Urban Outfitters has 4 brands within itself. Urban Outfitters is one branch of Urban Outfitters itself. This is a segment of targeting 16 to 30-year-old individuals. We have 2 stores in San Antonio. Anthropology also targets around 18 to 50-year-old for women. They only offer women clothing. And Free People targets women of all ages. They also engage in some wholesale operations as well. And less than 1% of sales comes from the Vetri family, 13 restaurants they own. For the rest of this analysis, we're really going to kind of avoid that, considering it's such a minimal part of the company. So looking at their revenue and EPS growth, we've seen steady growth in revenue and EPS while their stocks kind of moved in different directions during the same period. We see strong growth in revenue from 2018 to 2019, increasing from around $3.6 billion to roughly $4 billion. And we see the spike in EPS from 2018 to 2019, really showing how the stock has performed and giving us more confidence moving forward. So a quick SWOT analysis on the stock. A couple strengths they have is the popularity they have with millennials and Generation Z. They have a great e-commerce site as well, one of the industry's best. And as they continue to migrate from kind of the retail model to the direct-to-consumer online model, we believe this is going to help their margins and their revenue both increase. They also have a very strong real estate portfolio for their physical locations. A lot of their stores are actually located very close to college campuses. That's why we have both Anthropology and Urban Outfitters at La Cantera. And we noticed this trend throughout the U.S. And they're also located in huge metropolitan areas. One weakness we saw is they're heavily reliant on being able to identify changes in fashion. So not all their product is proprietary. A lot of the stuff they resell from different brands such as Adidas, Nike, really any brand they want, they can do a wholesale order from them and kind of resell it at a higher price. Some opportunities we see is the continued expansion to Europe and Canada. We believe these markets are going to resonate well with the stock. And the growth of proprietary products is also increasing. So when you walk into a store and you see that their own products are selling much cheaper than these products from, let's say, Adidas, that are selling almost at twice the price for essentially the same product. One threat we see, is kind of general, is the intense competition throughout the apparel industry. It's one of the most competitive industries, I'd say, in the world. So we got to keep that in mind when looking to evaluate the stock. So fortunately, this stock had good segment data on Bloomberg. So we were able to look at the segment growth since 2011. As you can see, Urban Outfitters in 2011 was bigger than Anthropology, but through the years, Anthropology has grown to be slightly bigger than Urban Outfitters in terms of revenue. We also see steady growth from the Free People segment, and I would say exponential growth as well. The family restaurants, like we said, pretty relevant. So to break down the current segment, as of 2019, 38.7% of revenues are coming from Urban Outfitters, 40% are coming from Anthropologie, and 20% are coming from Free People. And the geographic breakdown, roughly 90% is coming from the US, and as they continue to expand, as of right now, 10% is in Canada and Europe, but the company is targeting approximately 15% in the next 2 years. So once again, we want to touch on the ownership. We believe there's a couple good indicators, especially for this stock. Richard Hayne, the CEO and chairman of the company, owns 17.3%, Vanguard owns 8.7%, and BlackRock owns 8.1%. Looking at the history of ownership, as you can see again, from 2018 Q3 to 2018 Q4, Richard Hayne has purchased more shares, and considering he's the chairman and CEO, this is a very bullish indicator for us. It gives us a lot of confidence. We see BlackRock has actually decreased their holding in the same period, but it's almost simultaneous with Vanguard picking up those shares. And the last thing we want to touch on is the PE comparison to their competitors. We notice they're trading a lot cheaper in terms of PE compared to their competitors. So American Eagle trading at a 14 times PE, Abercrombie & Fitch trading at 19.5 times PE, and Urban's trading at a very small 10.5 times PE, which is giving us more confidence. Arguably their closest competitor in terms of the product line is Zumiez, and they're trading at a 14.5 times multiple, further giving us confidence in Urban. Ralph Lauren also kind of has a different market. They're trading at a 17 times PE, so we believe for this reason it's undervalued. The next stock and the final stock we're going to be pitching you guys is Norwegian Cruise Lines Holdings. We're giving it a buy over rate rating. It's currently trading at $57.27. We see a smaller upside, but a significant one at that, at a 19% upside with a $68 price target. Out of the 22 analysts covering it on Bloomberg, 20 are recommending a buy and 2 are recommending a sell. And as you can see in this chart right here, it's a little bit of technical analysis. We can see that the 50-day moving average, which is the pink line, has crossed the 100-day and 200-day in the past 2 months, giving us more confidence in the stock and a lot of momentum moving forward, as well as support.
So next we're going to go to Norwegian brands, and they have 3. So the first one is Oceania, and that is, they have 6 ship fleet and a concentration on culinary experience, and they have something unique is a 180-day cruise, and that's by far the longest cruise they have. The second one is Norwegian, and that's the most common one. They have a 16-ship fleet and 300 locations, and that's very great because it offers many more opportunities for consumers to look on. And the last one is Regent, and that is the most luxurious brand they have, and it can be in the world too. They have 4-ship fleet and even more than Norwegian, 450 locations, and is unrivaled experience. And the thing about it is, if you call them right now, they're already all full, so you have to really plan that ahead and everything, so demand is not an issue. So going into their SWOT analysis, the first one we see their strengths is that they're a younger fleet with premium positioning, and something really unique about them is they have more balconies, so that is very important because that adds more value to the room and to the whole ship and cruise line in general. People really, when they go on these ships, they want to see what they're doing and they want to see the whole ocean. So it's something very unique that this cruise line has. It's also really important that it's unaffected by Airbnb. So we're seeing right now that Airbnb is very affecting the hospitality and also hotels and motels place. So this hasn't tapped into yet into cruise line, and I don't really see it going into it. So we thought it was very important to add a cruise line into our sector. Some weaknesses that we did see is under-penetrated in international markets, but we also see this as an opportunity because we can penetrate this market and increase market share and revenue. And so that goes really into our opportunities. And one threat that we see is the volatility in fuel price. So that's something that we have to really look more into in the future and see how we're going to tackle that.
And then just to bounce off Natalie, we did the Porter's 5 Forces. So their buying power is pretty moderate. They have limited options, or consumers do, when choosing a specific cruise line. There's only few that control this market. Their supplying power is actually really weak. Suppliers are really eager to work with this company specifically because ship sales are relatively high. And there's a limited concentration of marine service suppliers and stevedores. And also the barrier to entry is really high. So prices for just one ship ranges anywhere from $200 million to $1 billion. So that capital is high for someone just to come into the market. And there's potential for ports to enter into this segment or to go to specific home ports. It's really difficult for someone to have the logistics of just going to a port when they're always in use. So the threat of substitution is pretty low. So that's good for our industry growth. And it's because of limited resources and organizational capabilities. So Hudson's gonna go more into the numbers of this.
So looking at the performance, we wanted to put Norwegian Cruise Lines against Carnival Cruise Lines, considering Carnival Cruise Lines is the largest cruise ship brand in the world. They have the largest market cap, and for that reason, we thought it'd be effective to compare the two companies before making an investment decision. As you can see in the year-to-date chart, Norwegian Cruise Lines has outperformed Carnival Cruise Lines, as well as in the 5-year chart as well, which is giving us confidence that the stock seems to have a significant amount of momentum. Looking at the revenue and EPS growth, as you can see, the revenue is very different between the two lines. Carnival, like I said, is a much larger company, so we don't really want to focus on revenue itself, but more revenue growth. As we can see, in the past 7 years, Norwegian has increased the revenue from roughly $2 billion to $6 billion, a much larger increase in terms of percentage than Carnival Cruise Lines, which increased from roughly $15 billion to roughly $19 billion in the same period, marking a much lower percentage gain. EPS, you can see it's a lot more comparable. They correlate pretty strongly. As you can see, Norwegian Cruise Line has kind of caught up and they kind of fell behind, but we expect this trend to reverse in the future, and we expect Norwegian Cruise Lines to increase their EPS much higher than Carnival Cruise Lines. And they also have a lot less shares outstanding, which is important to know moving forward. So touching on the ownership again, the 4 main holders are Vanguard, Capital Group, T. Rowe Price, and BlackRock. Vanguard owns 10%, Capital Group 9.8, T. Rowe Price 8.9, and BlackRock 6.63. Looking at the recent history of the holdings, as you can see, Capital Group has made a significant investment from 2018 Q3 to 2018 Q4. Same for Vanguard, they've also increased their holdings in that same period. T. Rowe Price seems to be decreasing their allocation, but considering BlackRock is also increasing from that same 2018 Q3 to Q4 period, it gives us a lot of confidence moving forward. The last thing we want to touch on is EPS and revenue growth. Like I said, this stock has been growing at a much faster rate than its competitors. Looking at the revenue growth, it has a growth rate of 12% versus a 7 and 8% from Carnival and Royal Caribbean Cruise Lines. EPS growth, this is the biggest difference we saw. Norwegian Cruise Lines has increased their EPS by 25% in 1 year, while Carnival has only increased theirs by 9.4% and RCL by only 18%. And for that reason, we're bullish on this stock. Any questions?
I know you're time constrained. What would you have done more of or done differently if you had more time? I know you mentioned one thing, which is in the cruise line discussion, that you looked at the fuel volatility and fuel pricing and how it affects the cruise lines. But anything overall, in any part of your analysis, would you have done something more, done something differently if you had more time?
Well, first off, we could have looked at fuel prices. Futures for that definitely would have been helpful for our analysis of the companies. Urban Outfitters, we wanted to actually go visit a couple stores. We wanted to visit the one in La Cantera and North Star. Unfortunately, we didn't have time. We also, like I said at the beginning of the presentation, we wanted to short stock Mattel. We've seen revenues continue to fall and EPS continue to fall for that stock. So we thought we had a good rationale for that pitch. Unfortunately, we didn't have enough time to pitch it.
I also think more in depth, because we've done a lot of research, of course, because we're consumers as well, about each stock. We had so much more extensive research on each one. I guess that was something we wanted to present more of, but we just wanted to condense that
Okay.
a little bit more. Yeah.
Anything else? Well, thank you guys for coming out. Means a lot.
Y'all know how much that 180-day cruise costs? Anybody want to guess?
$100,000.
Well, they're showing the starting price around 50,000. Oh my word!
Yeah, and for Region, like you can't find the prices anywhere. You have to call for a quote,
Yeah.
and it'll take months. So
Yeah.
I would go crazy.
One of the portfolio, and actually I think it's in one of the portfolio where I'm portfolio manager, one of the portfolios where I'm not, but one of the PMs works for me, this is tied for the largest whole relative
Mhm.
overweight in one of the portfolios I run, and it's the largest overweight in one of the other portfolios.
Oh, really?
Wow.
Norwegian Cruise Lines.
Oh, good.
Yeah,
You agree?
just interesting.
Yeah.
Thank you
Good
guys.
job.
Thank you so much.
Thank you.
Rest of your day.